Assalamualaikum warahmatullahi wabarakatuh. We are going to present our group assignment. Before that, let me introduce our group members. Our group members consist of 1 NURSYAKIRAH binti 1 Muhammad AZMI, SYAIRAH AQILAH binti Muhammad ZAMRI, AMIRAH SYAZANA binti MASRI, NURUL WAHYUNI binti ZAKARIA, and Sharifah Noor Ezzah binti SYED AHMAD FUAD. So, I will start with the background analysis. We analyze each of the stock based on their industry and also their market capitalization. We also include their major competitors in their industry. So, in the background analysis of each of the stock, as you can see that we choose different industry for our stock because we want to analyze the volatility of each stock in order to know that which company is the most volatile and good to invest and which one is not. Plus, we also analyze their market capitalization of each stocks. Market capitalization is the market value of a company's outstanding shares. So now I will explain about the background of each of the stock. First, we start with the Sterling Bank Corp, in which it is under financial industry. It has a market capitalization of 5.528 billion. And its major competitor is Bank of America Corporation, BAC. The second stock is FedEx Corporation, FDS, in which it is under services industry, and it has a 66.09 billion market capitalization, and its major competitor is United Parcel Services, UPS. Thirdly is Twitter, and it is under Internet Content and Information Industry. It has 23.275 billion market capitalization, and its major competitor is Facebook. Next is Skechers, under industry of footwear and accessories. It has 4.818 billion market capitalization, and its major competitor is NKE. Lastly is Intrazone Corporation, XON, under biotechnology industry. It has 2.083 billion market capitalization, and its major competitor is Medtronic plc MDT. As we can see that FedEx Corporation has the highest market capitalization among the 5 stocks. So, is it good to have a high market capitalization? Actually, companies with large market capitalization tend to have more assets, capital, and higher revenues than those with smaller market capitalization. A company with a large market capitalization is not necessarily better than any other company. A large market capitalization is simply an indication of the size of the company. So now I will proceed with the ratio analysis. But before I start my analysis for each of the stock, let me explain briefly the meaning of earning per share, dividend payout ratio, analysis price, and market price. Earning per share is the monetary value of earning per outstanding share of the common stock for a company. Dividend payout ratio is the amount of dividend paid to the stakeholder. And the analysis price is the analysis of consumer response to theoretical prices in survey for their research. And lastly, the market price is the current price of the stock. For the earning per share and dividend payout ratio, it is good to have the higher EPS and dividend payout ratio in order to attract the investors. So we start first with the STL and BAC. As you can see that BAC has more experience than STL, and the value of EPS for BAC is also higher than STL. However, BAC dividend payout ratio is slightly lower than STL. Next is between Twitter and Facebook. Even though Facebook has only 2 more years experience than Twitter, but we analyzed that Facebook has laid all the values with a big difference from Twitter.
Okay, my name is SYAIRAH AQILAH, and I'll continue to present the ratio analysis. We'll start with the company FedEx and its competitor, which is UPS. First, I'll start with the years of experience. From here, we can see that the difference between FedEx and UPS is quite far, which is UPS has 110 years of experience and FedEx has 47 years of experience. From here, we can see that UPS has more knowledge and experience in the industry. But that again, but then later on, I would like to share the earnings per share for FedEx is relatively higher compared to UPS, where FedEx has 16.39 ringgit per share compared to UPS. But going further, we can see that the dividend per ratio for UPS is quite high. So dividend per ratio is the dividend given to stockholders of the company. In UPS, stockholders are given 58.32% of dividend. Compared to FedEx, the stockholders are given 11.59% of dividend. Now, I'll go to analyst price and also market price. The difference between market price and analyst price is the price of the stock that is forecasted by the analyst, and the market price is the current price of the stock in the market. Analyst price and market price is not that far, and the market price are usually affected by the analyst price. So from here we can see the analyst price and the market price of FedEx is not that far, and also for UPS, the analyst price and market price is also not that far. Okay, so now I'll move on to Skechers and Nike. Again, the years of experience between Skechers and Nike is relatively quite far. And we can also see from its earnings per share, its dividends per ratio, its analyst price, and also its market price. So for its earnings per share, it has 2 ringgit and 31 cent per share, and its dividend per ratio is 33.04% compared to DPR of SKX, which is they give out 0% of dividend for their stockholders. The analyst price and also the market price of Skechers are quite far, with a difference of 12.21 cents. But for Nike, the difference between the analyst price and also the market price is not that far, which is 0.02 cents. Okay, so and also last but not least for the ratio analysis. Okay, so and also last but not least for the ratio analysis, I'll explain on XON and its competitor, which is MDT. The years of experience between XON and MDT is quite far, which is 49 years. So that shows the difference between its earnings per share and the DPR, the analyst price, and also its market price. Here, I would like to highlight its earnings per share is negative 0.98. So we can understand that the company is currently not performing well because it has a negative earnings per share and its dividends per ratio is 0. So it does not give any dividend to its stockholders. Compared to MDT, its competitor, its MDT's earnings per share is 2.04 cents, and its dividends per ratio, which is quite high, 88.73%. And its analyst price and also its market price are not that far. Comparing again with XON, the difference between its analyst price and also its market price is quite far, because the analyst forecasted that the price of XON would go to 33.17 cents, but it does not manage to go up to that level. It is currently on 16.11 ringgit. Okay, so now I continue. To explain on the company's strength and opportunities. I'll start with Sterling Bancorp. The strength of Sterling Bancorp is positive improvement on relative strength rating, and its opportunities is more investor enter into the stocks. Next, I'll go to Twitter. The strength is its early entry in social media business, and its opportunities is search engine business. The strength of Twitter is where it is an early entry, because back in its years, which is in 2006, there was not many social media competitors except for Facebook. So from here, it has a strength compared to others. And its opportunities is search engine business, because it serves a platform for everyone to search anything in the social media. Next, I'll go on to FedEx Corporation. Its strength is economies of scale, and its opportunities is e-commerce boom. The opportunities for FedEx, which is e-commerce boom, gives them a push because as we move along the way, the e-commerce for the platform of e-commerce is helping almost everyone in the business. So I'll move on to Skechers. Its strength is highly skilled workforce through successful training and learning programs, and its opportunities is new customers from online channel. Again, like I've said before, as we move through times, people use the internet more than the actual real life. So people can see the promotions made by Skechers, and from there they are interested to buy Skechers. Hence, Skechers has the opportunity, and Skechers gain some opportunity from that. Last but not least is Intraxon Corporation, which is XON. Its strength is high level of customer satisfaction, and its opportunities is opening up new markets because of government agreement. Now, I'll pass the floor to my friend. Thank you.
Assalamualaikum warahmatullahi wabarakatuh to everyone. My name is Noor WAHYUNI binti ZAKARIA, and I would like to share with all of you about our company's simple moving average. Before we go further to our discussion, let me explain a little bit about what is simple moving average. In these few slides, I will referring it to SMA. Generally, moving average is one of the core indicators in technical analysis, and SMA is the simplest form of moving average. SMAs are often used to determine the direction of the current trend. It is also commonly used to smooth price data and technical indicators. The longer the period of the SMA, the smoother the result will be. Moving on, let us look into how SMA is calculated. To find SMA, we need to calculate the average of a set of number from past data points. The answer will give traders an idea of how an asset is priced relative to the past days. The result need to be plotted onto a chart and allow traders to look at a smooth data. The most common period used in SMAs are 15, 20, 30, 50, 100 and 200 days. The shorter the period, the more sensitive it will be to price changes, and the longer the period, the less sensitive it will be to price changes. So, how do we use SMA to help our trading activity? Traders usually use the price line crossing the SMA's line to trigger trading signals, whether to go long or short. We can go long or cover short when price line crosses above the SMA's line, and when the price line crosses below the SMA's line, it is advisable to go short or exit long. In addition, the SMAs crossing SMAs also can be used to trigger trading signals. We can go long whenever short period SMAs crosses above the long period SMAs, and vice versa. Now, let's put theory into practice. This is the SMA's line for Sterling Bancorp STL. I use the SMA 50 days and SMA's 100 days. From the first glance, we can see that the closing price for this company is moving up. There are a huge gap between January 2015 to January 2017 with a difference of 10.22. As what we have discussed earlier, we can observe that every time SMA's line is pointing up, the price is also increasing. Next, if we zoom the graph, we can clearly see some intersection between both SMA's line. There is an intersection in arrow 1 where the short-term SMA crosses below the long-term SMA. In this situation, it is advisable for us to go short. However, we can see the opposite situation in arrow 2 where the short-term SMA's line crosses above the long-term SMA's line. We can see similar cases in the last arrow. In conclusion, it is better for us to go long for this company as the price keep increasing and there is no signal for short appear after the third arrow. As for Skechers, the price rocketed from 18.41 to almost 60 at the early tenure. However, it dropped sharply after it reached 53.43 in 8 May 2015. But by the end of the 2016, the prices for this company are rising gradually. In addition, there is an intersection in Arrow 1 where SMA 50 crosses above the SMA 100. Again, for this company, we better choose for long. Next, we will analyze the FedEx Corporation FDX. From 2015 to 2017, it is clear that their prices is declining. Surprisingly, both Skechers and FedEx reached at the top in the same time before started to go down, which is at 68.71 in 8 May 2015. I wonder what happened at that time that affect both of the company drastically. This is what we can see when I zoom into the last tenure for this company. In the first arrow, the short-term SMA's line crosses below the long-term SMA's line, which trigger the signal for short. While in the second and third arrow, it also gives the signal for short because the price line crosses below the SMA's line. So, for this company, it is advisable to go for short. After analyzing two companies that experience a fall in their price, our next company, Intraxon Corporation, XON, is having an increment in their prices. So, should we go long or short? Let us go straight to the last few months. The first arrow shows interception between two SMA's line, which trigger the signal for long, since the SMA's 50 lines crosses above the SMA's 100 line. The second arrow also trigger the same signal, because we can see that price line crosses above the SMA's 50 line. Thus, it is long for this company. The next one is the company for the famous Twitter. When we first look at the graph, we know that the company also is experiencing a decline in their prices. So, should we go for short? As usual, let's look into the last few months. For this company, their data is quite volatile with so many ups and downs. However, the arrow shows the intersection between the SMA's line where the short-term SMA crosses above the long-term SMA. When this happened, it is a signal for long. In addition, the prices line also crosses above the SMA line and trigger the same signal. However, in my personal opinion, I would not buy these shares because of the volatility. We better wait for the price to stable before buying it. That's all from me. Thank you.
In the firm's analysis, we can compare all of the 5 companies' return, standard deviation, covariance, and beta. Skechers have the highest return. Meanwhile, FedEx have the lowest risk. In the theory, the lower the risk, the lower the return, and the higher the risk, the higher the return. If we want to gain more, we have to face the higher risk. And if we just want to play safe, we can just invest on the lower risk stock but gain less. FedEx Corporation also have the best covariance and beta. The market has beta above 1.0 and FedEx Corporation have 0.9 beta, which is most close among all of the 5 stocks. If we look at the portfolio analysis, we can see that our return is positive, which is good, and our portfolio risk is high. Meanwhile, the beta of our portfolio is lower than the market beta. When the beta is lower than 1.0, it means the portfolio have the lower risk and return. The covariance show the measure of the degree to which return on two risky assets move in tandem. A positive covariance means that asset returns move together. A negative covariance means return move inversely. Covariance is closely related to correlation, wherein the difference between the two is that the latter factors in the standard deviation. In our analysis, the only negative covariance is between the sketches and Twitter stocks. It means all of our stock is moved together, which is not good in the diversion.
Assalamualaikum warahmatullahi wabarakatuh. My name is Sharifah Noor Ezzah. So, I'm going to proceed with the portfolio evaluation. For portfolio evaluation, we need to calculate the three types of portfolio performance, which are Sharpe, Treno, and Jensen. The Treno, Sharpe, and Jensen ratios combine risk and return performance into a single value, but each of them have a slightly difference. From what I gather, Sharpe's measure excess return on risky portfolio, Treno's measures excess return compared to risky portfolio, and Jensen's measures excess return over CAPM on portfolio beta. Now, I will explain a little bit about Treno, Sharpe, and Jensen measure. For Treno measure, introduce the concept of the security market line, which defines the relationship between portfolio return and market rates of returns, whereby the slope of the line measures the relative volatility between the portfolio and the market. The beta coefficient is simply the volatility measure of a stock portfolio in the market itself. The greater the line's slope, the better the risk-return trade-off. The Treno measure is portfolio return minus risk-free rate and divide by beta. As a result, the higher the Treno measure, the better the portfolio. Okay, for Sharpe ratio, it is almost identical to the Treno measure, except that the risk measure is the standard deviation of the portfolio instead of considering only the systematic risk, as represented by the beta. The formula for the Sharpe ratio is portfolio return minus risk-free rate and divide by standard deviation. Unlike the Treno measure, the Sharpe ratio evaluates the portfolio manager on the basis of both rate of return and diversification. Therefore, the Sharpe ratio is more appropriate for well-diversified portfolios because it is more accurate, takes into account the risk of the portfolio. Okay, lastly, for Jensen measure, the Jensen ratio measures how much of the portfolio's rate of return is attributable to the manager's ability to deliver above average returns, adjusted for market risk. The higher the ratio, the better the risk-adjusted returns. A portfolio with a consistently positive excess return will have a positive alpha, while a portfolio with a consistently negative excess return will have a negative alpha. So, the formula is total portfolio return minus risk-free rate minus by portfolio beta times market return and minus risk-free rate. So, now let us see Sharpe, Treno, and Jensen measure for the portfolio and the competitors. Okay, as we can see that at the portfolio in the Sharpe, the FTX is 0.077851 and it is the highest compared to the other 5 stock, while at the competitors, Facebook has the highest measure of 1.243333 compared to other competitors. Okay, for Treno measure, the portfolio for the 5 stocks, most of them show a positive number and a higher number of measure, but Twitter showed the lowest with the amount of 0.03277 and 9. So basically, Zone has the highest number of measure. So for Treno, Zone is better as the number is 2.191358. While for the competitors, Facebook showed the highest number of measure with the amount of 3.484386. Okay, lastly, for Jensen measure, okay, compared to the Sharpe and Treno, both of the measure said that they will take the higher the better. But for Jensen, positive returns are preferred and negative returns indicate that required return was not earned. Hence, as we can see that all of the stock for the portfolio and the competitors show a positive returns, and it indicates that the required return was earned. So, as we can see, for the portfolio, The company is Twitter, show the highest positive return with the amount of 0.2296, while for the competitors is Facebook with the amount of 0.2416. As overall, we can see that for the competitors, Facebook show that it is good as for the sharp, trending and transient measure, it has the positive and higher return. Lastly, as for recommendation, I would recommend the audience to acquire SKX Skechers due to some reasons. For long term, this company is likely trying to develop and expand their business more in the future. Because of that, they have zero DPR. They might reinvest most of their earning for future development of the company. So, for long term, this company looks promising. They also have positive EPX, and their market capitalization is 4.818 billion. For short term, based on our analysis using SMA Simple Moving Average, this company shows an uptrend in their prices, and it is less likely for this company's price to fall down in this short period of time. So, for short term, this company also is one of the best choice among other companies in our portfolio. Apart from that, judging from its beta, SKX is less volatile than the market. It seems this company price stay relatively stable and their security is also less volatile. Lastly, you might want to consider STL to be included in your portfolio because after SKX, STL also shows a promising return to the traders.